What's going on, guys? This is Lior and welcome back to my channel. Now, in this video, what I thought I would do is break down one of the most interesting and probably one of the least understood tax benefits of investing passively in big multifamily syndication. So I'm going to break down depreciation, accelerated depreciation, and bonus depreciation. I'll give you guys specific numbers, and you want to make sure to tune in on this one because this has the chance to save you a ton of money on your tax liability. So we're going to get after it right now. What's going on, guys? My name is Lior and welcome back to my channel. Now, as I said in this video, we're going to be talking all about the tax benefits of depreciation and investing in multifamily in this video. But before we get into it, two super quick things, guys. Number one, if this is your first time on my channel, first of all, welcome. Second of all, make sure you smash that subscribe button for me. I put out weekly content on this channel all about investing in multifamily, renovating apartments, value add stuff, how to think strategically about your portfolio. So if that's the kind of content you're looking for, make sure you subscribe. And number two, guys, if you are thinking about investing passively in multifamily, right? If you want to invest in multifamily, but you don't want to be that lead operator who does all the work and is responsible for all the day-to-day, make sure you hit the link below, set up a call with me and my team. We have so many of you guys investing passively in our multifamily deals all over the country. So if you're interested, make sure to click that link and we will definitely help you out. So with that, let's get right into the meat and potatoes. And as I said, I'm going to do a very deep and numbered breakdown of this kind of mystifying concept of depreciation that a lot of people know about, hear about, but that may not really understand the nuts and bolts of it. So here's the deal with depreciation, right? Let's start with the basics, which is straight line depreciation on property, right? So first of all, depreciation can only be used on investment property, right? So obviously it's gonna have to be something like a multifamily building that we buy for investment purposes. So generally what you can do in real estate, and I kind of got some very technical language for you, which we'll break down as well. Generally you can use annual depreciation, right, as a deduction from your pre-tax income, right? And basically what that means is the IRS says, hey, you can depreciate any physical aspect of your property, right? So what will happen is you break down your property from the structure versus the land, and the actual structure you can depreciate, right? And a lot of you guys probably already know this, right? You can depreciate the land. And on a straight line depreciation, essentially what you can do is depreciate the property over the course of 27.5 years. That's kind of a standard depreciation deduction. So let me give you guys an example just so we can kind of put some real numbers behind what does this mean, all right? So we know you can depreciate the property over 27.5 years. So let's say we have a piece of property which has a value of $34 million, right? And let's say of that $34 million, we deduce that the land value is $6.5 million, right? So that means the actual property value is $27.5 million. So what happens in this calculation is that $27.5 million is divided by 27.5 for an annual deduction, right? And that comes out to $1 million per year. So this $1 million per year is a loss that you can claim as the investors in this property, right? It is a straight loss that you can use because the IRS allows us to claim that as a paper loss. Now, let's say you invested passively in this kind of deal, and let's say, there's 50 investors, who cumulatively invested to fund this kind of multifamily syndication. That means of the $1 million, each investor, let's say they invested equally, would get about $20,000 of straight paper loss to their bottom line, right? So they can take this loss directly to them. So now that we talked about regular straight line depreciation, let's go to the next level, which is accelerated depreciation, right? And the concept behind accelerated depreciation is this, right? Not everything in multifamily needs to be, all the physical aspects need to be depreciated over the course of 27.5 years. There are plenty of items in the actual property itself, right, that are physical that you can actually depreciate on shorter schedules than 27.5 years, right? Anything from 5 years and up. And the way you kind of go through this exercise is you do what's called a cost segregation study, right? So you hire a company, they come in, they do measurements of all the different physical attributes of the building, And they can basically come up with, individual depreciation schedules for the different physical aspects of the building. So basically what the net result will be is by doing this sort of study, you can essentially accelerate, right? Hence accelerated depreciation. You can accelerate the schedule of depreciation and be able to get more depreciation on a quicker schedule. Instead of basically taking the gross property value and then doing that 27 and a half year depreciation, where let's say you're a passive investor in this kind of deal where you're gonna get $20,000, by doing this cost segregation study, you can actually get more depreciation coming to you. Now, why would you care? Well, the more depreciation you have, again, the more paper loss you can declare as a passive investor in that deal. And I'll give you guys an example shortly, just so it really makes sense. But if you're thinking, well, how does this actually flow through to me, right? What will happen is every tax season, you're gonna get something called a Schedule K-1 from the operator that's running the deal. And basically all these losses are gonna flow through directly from the property to you based on your pro rata share, right? So the more depreciation that the property can take, the more depreciation you'll get. And again, your paper loss is gonna be bigger, allowing you to deduct more against your other passive income sources. And this brings me to a really important point, right? So you might be thinking, okay, does that mean that I can declare these losses against my job that I'm at working every day? And the answer to that is actually no, right? So not to get super in the weeds of things, as a passive investor, you cannot take these losses against your W-2 income, but what you can do is take these paper losses that you're receiving and take it against other passive income stream that you're getting from other K-1s in your investment portfolio, right? So let's say you're invested in other real estate deals, or you're invested in other partnerships or businesses that are producing passive cash flow for you. You can take the losses you're getting from this particular syndication that you're getting from that extra depreciation and take those to counteract any tax liability from your other passive income sources, right? So for someone that's got a lot of different passive income streams, let's say you've invested in other syndications, you've got other passive real estate income, maybe you've even got some passive business income, this is huge, right? Because you can take these deductions and mitigate your tax liability on those other passive income sources. So now let's actually put some firm numbers just so you guys really understand how this math works. And I kind of drew up an example right here, right? So let's say you have two investors in this deal who each invested $50,000, right? Now, let's really break out the math, right? Let's say year one, they each get a 6% cash on cash return, right? Because, of course, you're still gonna make your passive income being a passive investor. So on that $50,000, they each make $3,000 per year. Now, let's say that each investor now received $8,000 in depreciation annually, right? So let's do two examples, right? Let's do investor one, who has no other source of passive income right now to declare against. So what his tax form is gonna say, right? He's gonna say is you made $3,000 in distributions. Now you can take $8,000 of depreciation, right? Which means you're gonna pay $0 on that yield that you made, that $3,000, and you have $5,000 of the depreciation benefited, right? That you can bank on in future years, right? So basically that $3,000 minus $8,000 equals minus 5. So you have that minus $5,000 that you can take as deductions against other passive income sources. And one other key thing too is it's not only in this year's income sources, you can actually carry that loss forward, right? So let's say in that year 2 or 3, now you've invested in a couple of other deals, they're starting to make you some money. You can carry that $5,000 over, even if you can't use it this year, to future years, right? Mind equals blown. This is huge. Now let's go over the second example, investor number 2. Now let's say this investor has $4,000 of passive activity gains from other sources, right? So let's say you're someone that already has invested in other multifamily deals, or you have some other business income coming in, right? Where you are getting that, passive income. So the way that your math is going to work is, again, you made $3,000 this year from this deal distributed, plus $4,000 from other passive gains, which equals $7,000 in total passive gains. Now, because you have $8,000 in depreciation, you're gonna pay $0 on that $7,000 tax liability, right? So you're not gonna have any tax liability on that, and you still have another $1,000 that you can use in the future years as extra depreciation. So you can see how powerful this becomes as someone that's, growing their investment portfolio. Each of these actually leverage on each other, right? You can start to deduct your tax liability from one deal and the other by using the power of accelerated depreciation. Now we're gonna take it up one final level and talk about the concept of bonus depreciation. And bonus depreciation is something that's actually newer in this space. And basically what happened in 2017 through the Tax Cuts and Jobs Act is you can actually now take all of this accelerated depreciation and front load it to take it all up front, right? And now this has phased out, right? So starting 2023, so this year, this is actually phased out. So 2023, you can't take 100% of it. You can only take 80% of it. And 2024 is going to be 60%, 2025, 40%, and so on, right? But basically what this is allowing us to do is front load a huge chunk of this depreciation on the first year, right? So what that means to you as an investor, if you're strategic about this, is let's say you have some big passive gains from other income sources, right? Let's say you've invested in a bunch of other syndications, or your business that you invested in passively is just creating amazing returns for you, and you've got a big tax liability, right? You don't want to pay taxes on that. Then what you can do with bonus depreciation is we can literally take all of that depreciation we just talked about in the accelerated schedule and front load it to the first year. Now again, we can't take 100% anymore. 2023, you can only take 80% of that, but it's still a big chunk of depreciation that we can capture year one that you can use to mitigate any other passive income gains you have from other sources. So this is, when you really start to break this down and think about it, and you can become a really, really strategic investor by doing this, right? Because you can essentially figure out ways to collect these passive income streams almost tax-free, right? So that's the extra kind of punch of that bonus depreciation when you combine it with accelerated depreciation, and you can see why this is such a powerful tax strategy. So hopefully that kind of made sense. I know I kind of became very nerdy with you guys and we broke down the details here, but this is really, really important stuff. I mean, the tax advantages of investing passively, especially in stuff like multifamily, it has so many huge advantages, depreciation being one of the big ones. So hopefully this makes sense, guys. Of course, if you have any questions, comments, put them in the comments below, and I will definitely help you